Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me would be the smartest guy in the room, Mr. Michael Becker. Unfortunately, he is on a due diligence assignment. So he's physically up on a roof looking and inspecting a flat roof on a fairly new property. So he has his hands filled today. So filling the podcast, the man himself, Mr. Ricardo Hinojosa. Ricardo, how are you?
Doing fantastic. Thanks for having me on, Paul.
So Ricardo, as you know, is one of our superstar loan originators for Old Capital. Not only does he originate loans, but he's also an investor too. So he invests in multifamily property, which I think gives him kind of a leg up on a lot of people that just originate debt and equity, that he is actually an operator. He kind of understands a little bit about how these properties work. And so we're fortunate to have him on our team. Remind me, Ricardo, how many units do you guys own and manage?
So we directly oversee about 1,200 units. And I'm also a passive investor and a key principal in a handful of deals. It does give us a great perspective to understand the other side of the table. So it's always good to understand what my clients are going through. So it helps.
That's great. And so Ricardo has been with us for a number of years, and he is just a superstar originator. So if you do have any questions concerning multifamily financing, he's the guy you want to speak with at Old Capital. So oldcapitallending.com, look for Ricardo Hinojosa on our team. Ricardo, we had today, 30 people in a conference room, all heavily masked up. And we had Nick Fluellen with Marcus Millichap. We had Jacob Anderson with Newmark. And then we also had Chris Dier with CBRE. So they were up on stage and they were this is kind of our first meeting in the last, 6 months. And typically we would have, 300-400 people at a meeting that Old Capital would host. But today, because of all the craziness going on, we just had about 30, and they were all sitting about 6 feet away from each other. So we had a good space. What was kind of some of your takeaways from our meeting that you took away from?
Yeah, for me, it was just getting the broker's perspective on what they're seeing day to day, because things are changing so quick. It's been an up and down last few months since COVID hit. But to understand how deals are getting done, one of the biggest things that I've seen and that the brokers mention is the amount of kind of off-market deals that are happening. They're off-market deals, but they're a little different than what they were pre-COVID. So now we're seeing deals launch, and then shortly after they're launched, we're finding that sellers potentially don't want to go through that entire marketing process for whatever reason. Whether it's alarming their staff, they don't want to deal with 30 tours. So a lot of deals are getting done up front. So these brokers are reaching out to a handful of potential buyers and making deals happen much, much quicker than they were before. So I think there's opportunities out there for individuals. You've just got to be networked and make sure that you're reaching out to these brokers on a consistent basis to know what's coming up.
I think that the takeaway also is the volume is starting to increase. So the COVID-19 discount really has not shown up. The discount really has come in the form of the capital markets, where interest rates have come down, where we were talking about interest rates back about a year ago at 4.5. Now they're down sub 3 in the 2.85, 2.9 if it's a green program. So just unbelievable interest rates. When I first got into the multifamily business, in banking business 35 years ago, interest rates were at 16, 17% on like a home loan and 21% on the prime rate. So just unbelievable numbers when you can actually get an apartment loan of say $10 million under a rate of 3%. So I thought that was very interesting. One of the things that I also heard too, which I thought was interesting, is thank God we live in Texas. Thank God we live in a land of opportunity that is landlord friendly. And there was a conference call that was put on by Marcus Millichap last week. And if you can get a copy of that, you want to get a copy of that, because I thought it was very interesting, very dynamic about what's going on in California, when it comes to multifamily, there's a thing called Proposition 21. Proposition 21, which is kind of a rent control proposition. And some of the things that are going on that's being proposed in the November 3rd election, of all the craziness that's going on in the election. But this one is really the ability to rent control some of these properties that have been on the ground for 15 years and what they can do to the landlord. And some of the things that we were hearing about is that there was one group that owned about 13,000 units up in Northern California, just a big ownership group, privately held, 13,000. They owned them in the Silicon Valley, so from San Francisco, San Jose, the Bay Area. And their average, I think, unit price was about $600,000 per door. And what I found was interesting about that is that if this Proposition 21 goes through, that they were talking about almost having an impact of $200,000 reduction. And that is huge. And what type of a $200,000 reduction would have in your portfolio it is unbelievable. One of the things that kind of threw me for a loop about 2-3 weeks ago when I was hearing about some of these things in California was a friend of ours that had a $700 a month reduction in their rent. They're smart people. They don't own a house. They rent in a nice apartment in the Bay Area, but their rents were reduced by $700 just to keep them in that property, maybe a 25% reduction of rents. That's the impact what's going on with the COVID and what's happening in California, and just craziness, and especially if things that are proposed in the state legislature about taking the state income tax from, I think, 13+% up to 16+%. I mean, more people are coming to Texas, and especially investors that are going to want to do exchanges into Texas. So, some just craziness going on, not only in the state legislatures about trying to change things, the capital markets going on crazy, the general election going crazy, this COVID going crazy. So, as they say, wait a few minutes and things will change. And so we're excited to have somebody that is pretty inspirational in the podcast today. So we have a guy that I think that you'll enjoy listening to about how he began his success. We have really kind of followed his track for the last couple of years, and he comes out of Texas, and he's going to tell a story about how his success started, and is it something that maybe you could do if you're just first getting into multifamily. You want to look to this guy as an inspiration about how he did it and how successful he's become. So in the podcast today, our guest is a gentleman named Tim Bates. So Tim, thanks for joining us. We appreciate you being with us today.
Sure. First of all, I'd say you may want to put success and successful in quotes when talking about us, but I appreciate the intro nonetheless.
That sounds good. So Tim, just on the surface, have everybody get a chance to get to know you and what's your background, what's your education, where you're from. Tell us a little bit about you.
My dad was in the oil and gas industry, and we grew up, spent 5 years in Scotland, 2 years in Singapore, then moved back to Texas. Graduated from TCU with an engineering degree, did that for a couple of years, and then my brother convinced me to start a home building company with him back in 2006. And as an engineer, I wasn't ready to run a small business, so I ended up going back to TCU, getting my MBA to learn finance and accounting and investments and debt markets. And we've had the home building business ever since. And then about 10 years ago, we decided we wanted to diversify, get into commercial real estate. The home building company was going really well. We were really busy. So we finally got the resources in place on our team to where I could spend a little bit of time working on the commercial real estate. And then 5 years ago, we launched Worth Commercial. I partnered up with Jerry Bowles here locally and started our company.
Well, that's fantastic. So most brothers go fishing for fun. You guys opened up your own high-end residential building company. How is that? Are you still doing that? Is that?
Yeah, I spent about half my time doing that. So we started when we were little. We used to sell candy out of our backpacks together, and then split the profits. And then we started swimming for golf balls, cleaning them up, selling them, splitting the profits. So we've been business partners for a long time. And yeah, it's been great. He handles all the construction. I handle all the business development. So we kind of got clear roles and we don't step on each other's toes on that front. So it's been great.
Yeah, let me kind of just even turn out on the single family construction. You're always having to kind of almost recreate a wheel all the time, because you either are looking for new people to buy your spec homes that you've already spent a lot of time and expose yourself to the market in case the market contracts and you cannot sell this property, or you can't find a buyer to do it, or you're out trying to find somebody that wants to build a house. So you're always out there looking for new clients. Tell me a little bit about it. Is that something that recreating the wheel every day? Was that something that was always going through your mind?
Yeah, that was certainly a huge part of why we started the commercial real estate company. Was there are so many things outside of our control that could affect how we do on a given year. Even like right now, there's a massive spike in lumber prices that is pulling back demand almost overnight. And things like that, we just wanted to diversify, have more consistent revenue streams that we saw out there in office, in apartment complexes, in self-storage facilities. So yeah, that was a big part, is not having to start over ground zero every year and have to rebuild our revenue stream, which is what you have to do in custom home building.
And you're building custom homes. And so what would be the average price of a property that you guys are building?
With dirt and everything, I would say average is probably $700,000 to $900,000 is kind of our sweet spot.
Which, in California, that's a low price end house. And some parts of Florida, that's a low price end house. But in Fort Worth, Texas, that's a mansion.
Yeah, that'll get you 4,000 or 5,000 square feet.
High-end custom trim work, all finished out, just beautiful. Custom cabinets, crown molding on top and bottom. Chair rails. If you have ever seen one of their properties and you could move from Arizona to Texas, you would love looking at what these guys have done. So, but you always have to recreate the wheel every day. You have to find new customers every day. And so I can see what the advantage would be to find an opportunity to kind of diversify your business. And so with that, let's talk a little bit about how you did it. And I'm going to let Ricardo kind of start the conversation with you.
You and I met probably 5-6 years ago as you were getting started. So talk about that process of, okay, we want to make the switch. We want to diversify. How do you go about building your team? How do you go about starting? And then tell us about your first couple deals and how that went.
Yeah. So we have always been, both on the home building side and the commercial real estate side, we have been of the mindset of we want to grow slowly and put really strategic pieces in place. We are not trying to close as many deals as humanly possible. We want to close really good deals. So because of that, it took about 2 years to close our first deal. That's just kind of the nature. That's how I'm wired, is I'm super conservative in my underwriting. But in that market, being really conservative made it almost impossible to get something.
Well, let's talk about that, because a lot of people, they get up to the edge of the diving board and they don't jump in the water. And you said it took 2 years. What were some of the things upstairs that were kind of holding you back from doing it? You say you're an engineer, so you're looking to measure 3 or 4 times before you cut once.
Right.
So what were some of the things that were playing with your head?
It was just over analyzing everything, just asking. I would flood the broker with an email with 25 questions about the trailing 12 P&L and why did this do this? And I'm sure those brokers early on were like, get this guy away from me. So I've learned a lot over the last 5-7 years of looking at stuff and what really matters and what doesn't matter and what moves the needle. So it really was just analysis paralysis. I froze in my tracks by spending too much time looking over everything. And at some point you just have to say, hey, we don't know exactly what's going to happen. This is a good enough deal. We've made the right decisions in our underwriting, and let's see what happens.
Did you, again, sorry about this, Ricardo, did you go to like educational mentoring classes to kind of learn some of the basics? Or did you just say, I got my MBA here. I'm a pretty smart guy. I can do this.
No, although I am pretty high on myself, I knew I wasn't going to be able to just make that happen. No, I took a real estate finance class when I was at TCU And truth be told, the model that we use for our underwriting originated from that class. So I went back through, looked through all my notes and looked through all the case studies that we did and how they analyzed deals and what the projections were and what to expect. And I started from that. It looks completely different now than it did back then. But yeah, it was literally just consulting my real estate finance. I was going through and rereading the PowerPoint presentations and just, trying to learn it all from there.
Good stuff. So talk a little bit more about, you mentioned your approach and the conservative underwriting. Give us kind of some feel for what do your investors look for and what do you look for? What are some of the key metrics and maybe how they evolved over the last 5 years as you've grown in the business and you feel more comfortable? What are some of the key things you look for when you're looking at a deal?
Yeah, for us, although at this point now we've done a little bit of everything. We've done deep value adds. We have one where we bought a 25,000 square foot vacant office building, and we're in process of leasing it up and selling the land. Most of what we do, what's right down the fairway for us, is buying something that's cash flowing already, where we're able to pay our investors, hopefully the full preferred return right off the bat. And then there's some upside. So that's kind of the trying to hit a single or a double with an existing cash flowing asset. So that's kind of what we look for.
But you started off in multifamily.
Correct.
Okay, so you went from multifamily to office.
Yep.
And then light industrial type of stuff, or what?
Yeah.
Yeah,
that's correct. So, and the office originated the guy that I partnered with on the commercial real estate side. He's got almost 15 years now of experience on traditional office brokerage. That's his background. That's what he does. He's got a team where they're out there representing tenants. They've got boots on the ground, uncovering things all the time. And so that was kind of our avenue into the office space and I'll tell you a story about one that we did where we were representing an architect who needed office space. And there was a building that had a medical tenant who took about half of the building. This architect was going to take about 30%. So it was almost going to fully occupy the building. The building wasn't for sale, but we were representing the tenant. So we went to the landlord and said, hey, we'd love to buy this building from you. So we bought the building, extended the medical tenant to a 7-year deal, put our architect in at a 7-year deal, and then we've since leased up the middle space. So that's what we're after. A lot of what we buy, there's a story to it. We're not just outbidding 500 other people that are looking at it. And that's one of the reasons why, I know a lot of other people out there, they're closing hundreds and hundreds of units, every month it seems like, and we can't keep up. We're only going to do maybe 2 to 4 deals a year, but we want them to be really good deals for our investors. And what that's going to mean is on a cash flowing asset, we're probably looking in the 17, 18, 19 range for a projected 5-year IRR for them. On a riskier one, the one that was 25,000 vacant square feet, we're projecting a 25% IRR for that one. So we feel like risk adjusted, we're giving the returns that our investors are looking for.
Sounds good. And I want to jump in here one more time. So let's go back to deal number one. You're still in the single family construction business. You're building homes, and now you're saying, hey, listen, we're recreating the wheel every day in this. And we like this business, but we like to have a annuitized business. Having a tenant that's going to be in this property for 12 months or 18 months or 36 months if we treat the tenant right. Tell me about your first deal that you guys got up to the diving board and you actually jumped in.
Yeah, the first deal, and again, based on our conservative underwriting, sometimes this happens, but we hit a home run on that. It was a 49-unit apartment complex. We held it for just over 3 years and had a 35% IRR on the deal. So it was, I guess all of my analysis paralysis paid off, at least on that first one, because that one met the threshold of what I needed to do to invest in it.
Yeah, let's talk a little bit more about this one. I mean, you paid X and you just didn't wait for 3 years to go by before, the cap rate compressed and you were able to sell. What type of rehab did you put into the property in terms of like dollars? On a per unit basis? Did you have to change management companies? Do you guys self-manage? How did you even get into that business?
Yeah, so we, on that particular one, the owner managed it himself. And he knew everybody by name. They loved him, but the rents were probably $150 below market because he was a good old boy and took care of his tenants. And
yeah, I remember that deal because I actually walked out or drove out to that deal to take a look at it. And the owner, I'm looking for the owner just to kind of do a view of the property. The owner, which I didn't know at the time, I thought was the maintenance guy.
Right. He was the maintenance guy.
Yeah, he was under the sink with a screwdriver looking to install I don't know if it was a dishwasher or if it was a garbage disposal, but, he looked like the maintenance guy.
Right.
And, I'm like saying, I'm looking for Tony or whatever his name was. He goes, I'm Tony. And he pops up underneath there and I find out that he's the owner.
Yep.
And, you're right. He was a good old boy on that property. Everybody kind of knew him, everybody, it was definitely, he was hands-on.
Yep.
And when you took a look at his financial statement, Tony wasn't paying himself.
Right.
Because you looked at the financial statement and you were like, all this maintenance stuff is being done, but he's not, since he's doing it, he's not charging it to himself or charging as a line item. And so you look at it and say, holy cow, I think we can operate this property at $2,300 a door in expenses.
Right. Yeah.
But the expenses was really twice that because Tony was doing all the work on the property. So tell me a little bit more about that deal.
Yeah, so we actually didn't put, it was not this crazy rehab deal where we put a bunch of money. It was literally just over time getting the rents up to where they should be. We certainly did a little bit here and there. But at that point, we had bought it for just a long-term hold. We liked the cash flow the way that it was. We had no intention of selling, but the rent just went high enough to where someone came and made an offer on it. And we ended up pulling the trigger and selling it.
Yeah, you guys, I think it was your brother, you and your dad put money into that deal. And you guys,
good memory.
Yeah, that was a while ago. I just remember that we were very positive on that deal. We knew that you guys were going to hit the ball apart. Property was built in 1968, 69, 70. It was an older property.
And with Ricardo owning 1,200 units or whatever, thanks for not buying that one out from under us.
But you guys did well. And so as a baby step, was the 40-some units, was that a good step to get into the business?
Absolutely. Yeah. So we kind of got our feet wet. We got to do that. We got more confidence with, and we don't do any management ourselves. That's one of the things I've learned from listening to podcasts like yours and other folks. So most people will advise to steer clear of that and let professionals do it. The margins just aren't there. So we let great teams handle our property management for us, and we kind of focus just on the asset management piece of it. And so it got us more confident with, how a deal, taking it full cycle, running through it. Yeah, we just felt a lot more confident moving forward to close on other deals. And it gave us the track record to raise outside capital as well.
That's great. Anything more to add to that, Ricardo?
No, you just mentioned the whole, the investors in the deal. So you started just family.
Correct.
And then you slowly expanded from there. At what point did you start raising outside capital?
It was our next deal. Our next deal, we
used
outside capital. Correct. That was always the plan. We just wanted to do some of the bumps and bruises on our own first to, learn from those mistakes.
Yeah, and a lot of people do that too. I mean, they're sensitive about the relationships from friends and family about investing into the deal. And so sometimes what they do is that they just kind of pass the hat around to their brother or their sister or their dad about raising some money. And then, we'll keep an eye on it, which they truly will. But it gives people confidence to do the next deal.
Yep.
And so that next deal was kind of an interesting one too. So tell us a little bit about that deal number 2.
The next one was Vista del Sol, which was a relationship we had with a broker. The seminary was selling the apartment, and so
let's turn off on that because that's an interesting one because Tim bought a property that was owned and controlled by a seminary, and so they owned it for a while.
Correct.
And I don't think they built it, but it was built 70s or so. That property. It was older property, but it was like student housing. So families would live in there that their spouse or a student that was going to seminary would actually live on that property. So it was owned and controlled by a seminary, and the seminary kept the property up very well.
Yes.
I mean, at least I thought so.
Oh, yeah.
And it was a great location, and that's a little bit of a different plan because it's a little bit like you're buying student housing on that deal, and that we had to be careful because the tenant base was like students, but it really wasn't students. It was older folks that maybe had a second job besides going to seminary, but the university, the seminary, was less than 10,000 students. So we had some challenges getting through it, but we got through it. But I think it's an interesting case study about you guys buying a property that was associated with a seminary. And so let's kind of go through it. How many units was that property?
I think that one was 54, if I remember correctly. So that was an interesting story where they only used it as needed. So it was, I think, 59% occupied. So the T12 was abysmal because the rent wasn't there. So we ended up meeting with the seminary, talking through our plan with them, with our property manager of how we were going to do things. And the plan was, hey, we'd love to keep these families in there, but we're also going to open it up to the public because every surrounding property was 95% occupied. So that one was a real quick turn. We got under contract, and 6-7 months later, I think we were up to 95% occupied, and then we sold it, and I think we had the asset for 9 or 10 months maybe. It was a real quick turn on that.
And then how is that financed, Ricardo, with that low occupancy?
Yeah, we actually had to go in and do bridge debt. So we worked with a local community bank, and there was a lot of emphasis on Tim's business plan. So it was you could really see the path, low occupancy. He had a really clear game plan of what he wanted to do. The previous owner just wasn't trying to lease it up. So, from a lending perspective, yes, the cash flow, the debt service coverage was really tight up front, but you could see a clear path to victory on that deal. And it was a matter of Tim going in there. You did have some rehab in that deal, didn't you?
Yeah.
Correctly?
That's right.
There were quite a few units that you had to bring back up. Talk a little bit about the rehab, because I remember that was a key component to making that deal work.
We didn't spend a whole lot. It was probably in the $1,500 a door, but it was just getting them up to what some of the market standards were. I think maybe the tenants that were there didn't require a lot based on their situation, so we just brought it up to just your basic vinyl plank. That there really wasn't much to it, but it was enough to where we were able to fill it up, raise the rents, and turn it around.
Yeah.
What gave Tim and his group that were buying it the strength to walk into a bank, with you, Ricardo? What was the bank really looking for that kind of got Tim the loan approved?
So a few things. One was the business plan. It was a very clear, I guess, again, path to, there's some rehab. They've got to operate it correctly. They've got to turn the tenant base and get it leased up. So it was pretty straightforward in terms of that. Now, Tim did need to sign recourse on the deal. It was a smaller loan. It was Tim and his family and some investors that came in. They had the net worth liquidity requirements, but it did require recourse. So it was a matter of the business plan and, the guarantors having the balance sheet to be able to back up a property like that. Any
idea what leverage on that deal? And that was an acquisition price plus rehab dollars that were added into it. Did you guys get 70, 75, 65? What was the leverage point for a property that was so low in occupancy going in?
I think we ended up getting decent leverage. I think we're around 70-ish%, including the rehab, if I remember correctly. So it was decent leverage. Again, it was the debt service coverage wasn't necessarily there going in, but the game plan was there and the business plan was there to vet it out.
And because you didn't have the occupancy and it wasn't really a strong product for an agency, a Fannie Mae loan, that was probably the reason why Ricardo didn't talk about doing a Fannie Mae loan for you. Yeah. Because I think Ricardo always talks to clients up front, and Tim knows this, that you kind of have to go with the game plan at the end in mind when you go into these deals. And a Fannie Mae loan, which would not be the right choice to go into it, because Tim knew that he had to fix a problem. He had to take a property that was low occupancy, kind of student-based, bring in market rate housing, bring in tenants to the property, raise rents, do a good job of reestablishing the rehab on the property and doing it correctly, and then give the opportunity to somebody else and buy it for X, sell it for Y. And how did you do on a rate of return on that one, Tim?
That one was also north of 30%. It was a great one. And what's interesting about that is we sold it, and this is kind of what we like to do. The person who bought it from us, they ended up turning it maybe 18 months later. So there was still some meat on the bone for the next buyer to buy it, do a little bit more, and make some money as well. So that's while we did leave a little of the return out there, our investors were happy, we were happy, and it's great that the next person got to make some money too.
Yeah. And met your criteria, and then in terms of the evolution of the property, now that deal, we know the current owner of that deal. That now the deal does have agency debt on it. Now it's stabilized. It's humming, and it's just now it's a different game plan than when you bought it. So it's kind of the evolution of how it works.
So that's really the takeaway, is making sure that you analyze how you're going to do this deal up front and how you're going to finance it. Is it going to be recourse, non-recourse? How long am I going to have it on my books? What's my exposure to my balance sheet? If it is a recourse loan, am I going to do it 80% or 75, or should I do it 65 or 60 and bring in some investors to assuage the risk on the deal? And I'm starting to see a little bit of a pattern here: 30% return, 30% return.
You're not all like that.
So past performance is not indicative of a future return. I got that. So that's good. And so I don't know if you want to keep talking about all these multifamily deals you've done in the last couple of years, but Ricardo, what else that we should be talking about for multifamily with Tim?
Yeah, so I think one of the unique things about Tim is how he uncovers opportunities. He kind of touched on it earlier, but your focus feels like it's primarily multifamily in terms of what you've been doing and what you're going to be doing going forward, but you'll mix in, self-storage and office, but some of that is because of the way you've built your team, right? Your team, you mentioned your business partner has the office experience. Talk a little bit about how you've built your team and then how that's helped you uncover some of these opportunities throughout the last few years.
Yeah, so currently we have 2 people that work for me that are underwriting pretty much all day. We have an asset manager who works for us, who oversees all the things that we currently have. And then we have a business manager who we couldn't live without our business manager. She's amazing. And then we also have Jerry, and he, on the traditional brokerage side, has 4 brokers that work for him. So yeah, back to there's almost always a story when we close something, and we encourage our guys to get out there, meet people face to face, have a drink with them, uncover things, find out what they're looking at, what they're talking about. And like, we have an apartment under contract right now that it was exactly what you were saying before. They didn't bring it to market. They're 1031ing into something else. So the most important thing was bring on a buyer that they knew they could close. So I think that's the reason they didn't want to send it out and have 30 different people take a look at it and, not trusting if they're going to close or not. So the broker reached out to us directly, and I think one other group, and we got to make a run at it. And those are the kind of stories that we can sell. Those are the kind of returns that our investors are looking for, because us outbidding 15 other groups that are frankly probably better at it than we are, that's never going to be what our investors are looking for. We feel like we have the team in place. We have the procedures in place to go and uncover great deals for our investors.
Fantastic.
Yeah. How do you find an underwriter to underwrite these deals? I mean, do you put an ad in Indeed? Do you call friends and family to kind of figure out who can underwrite these deals? What's their experience? How do you pay them? I mean, tell me a little bit about a little bit of your crutch.
Yeah, well, again, my background as a dorky engineer and MBA with a finance and investments degree. Yeah, it's just in my blood. I love crunching numbers. I can sit in a conference room and underwrite deals forever. So the people that we've brought on, one of them had some experience in the past, the other one did not. But it's just sitting down and going through deal after deal after deal and saying, hey, here's what I would look for it. And we kind of have a process of the things that we look for and how we do things. And actually, some of our notes are from the old Capital videos that have been sent out where we've said, hey, this is what we need to bake in for our underwriting for certain different things. And yeah, so it's just learning on the job, underwriting deal after deal. And it's great. I mean, The downside of being as picky as we are is that we probably don't make as much money as other people do. But the good thing is our guys are getting trained, at least in my opinion, on how to do it right and what to look for. And as you guys know, you can change one number on a spreadsheet and it can take a horrible deal to a great deal. And it's just, no, we're not going to do that. We want to be, we want to underwrite with integrity and make sure that the deal works before we send it out.
Let me, you are buying properties typically in your backyard.
Correct.
I don't think you guys have gone out to North Carolina or South Carolina or Atlanta or Phoenix to go out there. That to me is just not in your blood about what you do. So I want to ask you, why is that? Why don't you go out to these secondaries or tertiary markets away from you? How come you kind of stick with your knitting in your backyard?
We do. All of our stuff is in Texas. We do have a couple of assets. We have one in Waco and we have one in San Angelo. So that's as far out as we've gotten. Everything else has been inside the Metroplex. We love Texas like everybody else. The population growth is incredible. The strength of our economy is fantastic. We love the outlook of the apartment or the multifamily space. So there's a lot of reasons to be positive there. Most of our investors live here and they want to be able to go drive and touch it in a day if they want to. And buying something, and frankly for us, even the deal that we bought in Waco, one of the guys that works for us, he went to Baylor, knows the area really well. We did a bunch of underwriting, drove it, researched it all, which is totally different for us, at least, than buying something in Phoenix that I don't know anything about. So yeah, we just feel like in Texas, specifically in North Texas, it's just a good fit for what we know. I went to TCU. I've been here for 20 plus years. Yeah, we know the market pretty well.
Yeah, we're big believers of kind of on these smaller transactions that need more eyes on it, almost on a weekly basis about seeing what's going on with your investment, especially being kind of a fiduciary to your investors' money, that you want to stay on top of it and eyeball it. And we've talked about multifamily. Tell me a good story about another property type, because a lot of people who listen to our podcast are more multifamily driven. So if we talk about office or we talk about self-storage or things, some of the things that you guys have gotten into, I'd love to hear a success story about what you guys have done.
Yeah, on the office side, I know it's Chicken Little, sky is falling for the office, that there's going to be no market here in 12 months or something. We don't feel that way. So part of what we do is we do a lot of third-party leasing for other companies where, we're not the landlord, someone else owns the building, and we just help them lease it. We have one building that we own kind of right in the heart of Fort Worth off Hewlin. It has been unbelievable. We totally rehabbed the interior of it. We redid the exterior. It was a Class C building, and we repositioned it into a Class B. And the leasing in the midst of COVID has just been phenomenal. We took it from around 60%, and now we're over 90%. We just have one vacant space left, and we've been able to push rents. It's been fantastic.
And that really is exciting to hear, because everybody talks about doing value-added multifamilies, but when you do value-added properties that for offices and you put a new face on the building itself and you start to do interiors and lighting to these properties, really fires these things up that people want not only live in like a multifamily property, but want to live in an office building for the 16, 17 hours that they're doing something. So, what type of things did you guys do in this office building that really fired it up?
Yeah, and that one, this was a collaborative effort. We had a lot of voices in the room that kind of worked on it together. We had a great team. But we did all new bathrooms. The lighting was critical of getting, it was just this dark, dim, these corridors. We lightened it up, we brightened it up. We had a designer who helped with some of the selections to give it some pop, some design walls. But the biggest thing was we changed the staircase and did kind of the modern with the horizontal cable railing and the iron. Yeah, it totally transformed the entryway and just changed the look of it. But we redid the exterior doors. We did a new digital sign. We redid almost everything in that building, and it was great. We actually just had an open house Same sort of deal. Nobody's been able to meet with anybody forever. We did kind of a come and go open house to announce the conference room that's now going to be a shared conference room, a new amenity for everybody in the building. And seeing the people come in and just say, oh my gosh, I love what you guys have done. It is just amazing being here. It was a really great feeling that like, hey, we did something real and it's really worked out. So
if somebody wanted to look that up a little bit, let's brag a little bit about it. Is there a website that you guys have on that property or just the name? We
don't have a website. It's 3509 Hewlin Street, Fort Worth, Texas, 76109.
Is that on the north side of 30 and the south side of 30?
South side of 30. Don't kill me if that zip code's wrong, but it's it's 3509 Hewlin. It's a beautiful building. It's fantastic.
That's great. That's exciting. I mean, to try to change a little bit of the personality of a property is so important. So that always helps.
Yeah, and what's funny, a quick story about that is the person that we bought it from, they were saying like, hey, it's a $16, $17 a square foot building. It's always been that way. And we just had a vision for something so different than that. And yeah, we've been able to jump rates into a different stratosphere than the $16, $17. So it was just great being able to have a vision for what we think this building can be. And now here in the middle of COVID, being able to sign lease rates that are hitting the targets that we had, it's been awesome.
That's fantastic. You know, Paul, that's the second success story we've heard today on office. Paul and I were at an office building this morning that a similar story around leasing during COVID and how there are some nuggets in the office space as well. It just goes to show. I mean, you hear all the negative stuff in the news, but there appears to be opportunity across a lot of the asset classes.
Yeah, don't bury the office market just yet.
Yeah,
we're still kicking.
Good stuff. Are you actively looking for office opportunities?
We are. Yeah, we love the investment to buy the office. We can do the leasing on it, so it's a great revenue stream for us. So yes, we are actively looking for different office buildings, but it's tough sledding just like every other asset class right now in Texas.
Yeah, let's go back to when you were getting out of your MBA program. A lot of opportunities. You were looking all over. You were exploring different stuff, and you were kind of wide-eyed. And that's you back then. What are some of the things that you would advise the old Tim Bates into the new, just out of MBA school? What kind of advice would you give the person coming out of a school that really doesn't know what's going on? And what are some thoughts about that?
Yeah, I'd like to say that I did it all right and that I don't have any advice, but that's not the case. It was really, and this kind of ties into the story of why we started this commercial real estate brokerage. When we started our home building company, a couple years into it, I had twin boys and then had another son a couple years later. And for about 5 years, I would get home from work at 6, eat dinner, put the kids down, and then get the laptop back out at 8 and work from 8 until about midnight or 1 o'clock in the morning. And I did that for about 5 years. And it was great for business. The home building company grew. We did all the things we wanted to do. But that's one of the reasons why we started commercial real estate, is to say, I don't want to do that anymore. I want to have a more balanced schedule. I want to be able to invest in things that are going to be able to pay us back and have great people working for us. And I'm fine if they make a bunch of money too, because it's great. So we made the decision after a long time of like, hey, it's okay to hire great people to work for you. Let them get paid and stop working so much. And yeah, so I would say do that sooner. Don't wait 7-8 years into your career to do it.
You talked about you've got a couple of deals that you're working on right now, but talk a little bit about your equity raise strategy. So early on, it was just you and your family, and you opened it up a little bit. Talk about how that's evolved and what you're looking to do going forward.
Yeah, great question. So we historically have not had a lot of trouble raising money for our deals, and partly because we've got the track record. We can send out the summary that shows how our deals have done, and then the ones that we currently own, how they're performing. But we've been operating in the kind of $1 to $4 million space. So not to speak cavalierly, but the equity raise was relatively easy for those sizes.
Sure.
We're now pushing into the $6 to $10 million space. We have a couple of assets under contract right now, and it's just pushing our investors a little bit to try and fill those amounts. It's been fine so far, But that's kind of the space that we want to stay in and we know that as we do more and more deals, it's going to tax our investors. So we certainly are looking for other investors to participate in the deals and help fill some of these $6 to $10 million slots for us. And that's the asset. That's not the equity piece. That's the asset.
For sure. Yeah, good stuff. And your approach on these deals going forward, are you just building and looking for the same types of deals? Are you, we talk to other investors and, sometimes you've gone from one asset class to another. You're looking to go bigger, but is there anything changing about your approach and what you're looking for going forward?
Yeah, one of the things we did was we sent out during COVID when we had some time on our hands, we sent a survey out to our investors to get a feel for what are you looking for? What types of assets? What size checks are you looking to write? Would you be interested in a fund? And then what kind of return profile? Are you more of the higher risk, high reward? Do you like the stabilized cash flows? And it was really helpful to digest all that. And that's kind of shaped what we're doing going forward. So we actually are offering a little bit different of an investment package than we previously had, because we found we had some of our investors that said, hey, I want to participate in your deals, but I don't need a 16, 17% return with the risk associated with it. If you just give me a 10% preferred equity piece that you pay monthly, that's what I'm looking for. I've already made enough money doing what I do. Now I'm just trying to preserve my capital. I'm in the twilight years of my career. So we're carving out a piece of that in addition to the common equity. And we found that's been great because it's hitting all of our investors for what they're looking for. And it juices the returns for the equity guys as well. So it's win-win for everyone.
Fantastic.
Yeah, so I know that you do it SEC compliant and with PPMs and explaining all the risks that are involved in investing in multifamily or office or anything that does with commercial real estate. And as I say, past performance is not indicative of future returns. But, I think Tim tells a pretty compelling story about, measuring 3 or 4 times and then cutting once and jumping into multifamily, being an engineer background and making sure everything was done correctly and asking the broker the 30 questions and waiting for the email to be returned from the broker who's never going to return that email. And he's just going to move on to the next person. So you learn some valuable lessons about not asking those questions in an email, but maybe picking up the phone and asking just some general questions on the property itself. But, going from a couple of these smaller properties and really investing in their backyard, I always like that and these smaller deals. I hate to be an investor or a general partner that's going to invest in a small deal in an area that's 400, 500, 600 miles away. You just cannot. These deals take tremendous amount of labor, and you can't be on top of them, looking at them and see what's going on. So I kind of like Tim and his approach about what's going on, and just staying in their backyard, or being able to jump on a Southwest plane and be there in 45 minutes or so. Right. That's always a good idea to, just general ideas of real estate. So if people want to get more information, Tim, about what you and your company does, what's the best way for them to get a hold of you?
The best way is to email me at tim.bates, tim.bates @worthcre.net, not .com, .net.
That sounds great. Ricardo, is there anything that I missed asking Tim that I think you would think would be important?
No, I thought you did a great job. Great to have you, Tim. I think, seeing the progression over the last 5 or 6 years, we have a lot of guests on the podcast, and it's always interesting to see unique approaches, unique backgrounds, but there's always some key themes. And for you, it feels like it's been, it took a couple of years to get going, but the persistence, all the underwriting that you do, you're underwriting deal after deal after deal. It might take 2 years like you did on the first time, but you're doing that, you're building relationships. So the progression over the last 5 to 6 years has been fantastic. So kudos to you and your team. And that was the other theme that I think kind of stood out, is the team that you've built around you. So fantastic.
Yeah, one final piece of advice to tell my earlier self is, on a $4 million deal, don't ask why 6 months ago the telephone bill was $8 higher.
That's good. Some valuable lessons that we've learned from Tim Bates at Worth Commercial Real Estate. So, Tim, thanks for being on the podcast. We certainly do appreciate that. Ricardo Hinojosa, thanks for jumping in and putting this together. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.